You found the house, right neighborhood, right school. You're imagining your family there and someone else gets it. Not because they had money, not because they were smarter. They had one thing you didn't, a mortgage pre-approval letter. My name is Vidur and 7 years ago, I couldn't get approved for a basic credit card in this country. I moved here with nothing established. No credit, no Canadian work experience, no one sitting me down and explaining how any of this works. Today, I'm a licensed realtor in Ontario. I work with buyers across GTA and KWC. And every week, I'm sitting across from people who are exactly where I was. Ready to buy, ready to build something here, but operating inside a system nobody explained to them. That's why I started this YouTube channel. So let's fix that starting right now. First thing, because this confusion is everywhere in our community. Pre-qualification and pre-approval are not the same thing. They're not even close. Pre-qualification is a bank looking at some numbers you told them and saying, yeah, looks like you could probably afford around this much. No credit check, no documents verified, no commitment from anyone. A pre-approval is a different animal. The lender pulls your actual credit report, verifies your income, checks where your down payment is sitting, and then they give you a letter in writing saying, we will lend you up to this amount. That letter is what gets your offer taken seriously. If you're house hunting with just a pre-qualification, you're window shopping. The second you find something you love and try to make an offer, you're going to lose it to the person who actually came prepared. Pre-qualification is a conversation, pre-approval is a weapon. Get the weapon. Okay, this next part is going to surprise some of you. It's actually simple once someone explains it properly. Canada has something called the mortgage stress test. Here's the rule, plain English. When you apply for a mortgage, the bank doesn't approve you based on the rate they are offering you. They approve you based on a higher rate. Specifically, the higher of the two numbers, your contract rate plus 2% or a government floor of 5.25%, whichever is bigger. Right now, April 2026, the best 5-year fixed rates are sitting around 4%. Your rate plus 2%, that puts you at 6. That's higher than the 5.25 floor, so 6% is what you qualify at. What does that mean in real life? Let's say based on your income, you're thinking about a $800,000 home. After the stress test, your real approved amount is closer to $650,000 to $680,000. That's $120,000 to $150,000 less buying power. And that's before you've looked at a single listing. Think of it like a driving test on a wet road. The government's not testing if you can afford the house today. They want to know if you can still afford it when life gets harder. Rates go up, job changes happen. They're protecting you from becoming house rich and cash broke. It's not unreasonable, but it means you need your real number before you fall in love with something that's already out of reach. And that real number connects directly to your down payment, which is the other thing nobody broke down for me when I started. In Canada, the minimum you need to put down depends on the price. 5% on the first $500,000, 10% on the portion between $500,000 and $1.5 million, 20% if the home is above $1.5 million. No negotiating on that one. So a $700,000 home, that's $25,000 on the first $500K, plus $20,000 on the next $200K. $45,000 minimum, and that's before closing costs, which I'll get to in a minute. Trap 1. Misunderstanding the credit game. Here's the thing nobody tells newcomers properly. When you arrive in Canada, your credit score doesn't start low, it starts at nothing. There's no history here. Now, you've probably heard you need 2 years of Canadian credit history to get a mortgage. I'm here to tell you that's not actually true for newcomers. Every single one of the big 5 banks has a newcomer mortgage program. Scotiabank has Start Right, TD has New to Canada, RBC has Newcomer Advantage, CIBC and BMO have their own versions too. These programs are built specifically for permanent residents who have been in Canada less than 5 years. Some of them, TD for example, only require 3 months of full-time employment and don't require any Canadian credit history at all. So you can buy sooner than people told you. That part is real. But here's the smart move regardless. Start building your Canadian credit the day you land. Get a secured credit card from your bank this week, not next month. This week. Small deposit, small limit. Use it for groceries. Pay the full balance every month, not just the minimum. Why? Because newcomer programs get you in the door. But strong credit gets you better rates, more lender options, and real negotiating power. The buyer with 2 years of clean Canadian credit always gets a better deal than the buyer who's relying on the newcomer program alone. Both paths work. One is faster, the other gets you a better mortgage. Pick based on your timeline. Trap 2. Foreign income doesn't count. If part of your money is coming from outside Canada, like investments back home, a business in your home country, rental income from a property abroad, most Canadian lenders lenders will not count it. Your qualifying income needs to be Canadian, documented on paper. And if you just started your job, most lenders want to see at least 3 months in a full-time permanent role before they count that income. Some want longer. So if you just got your PR last month and just started working, you will have to wait. Get settled, let your Canadian income build a track record on paper before you go for pre-approval. Rushing this is one of the most expensive mistakes you can ever make. Trap 3. Big purchases after pre-approval. This one catches people in the middle of the excitement. You're pre-approved, you're house hunting, you're already picturing the furniture in the new living room. And then someone buys a car or finances a sofa set or opens a new credit card for their travel points. Here's what most people don't realize going in. Lenders re-pull your credit and recheck your finances right before closing. If your debt has gone up, if your credit score dropped, if anything in your financial picture changed since they approved you, they can pull the mortgage. I had a client last year who financed a car 2 weeks before closing. The bank rechecked, the numbers no longer worked. Approval pulled, lost the deposit, lost the house. You need to know this before you walk out of that pre-approval meeting with the letter, because the letter doesn't mean the finish line. It means the process has started. After pre-approval, your financial life goes on a lockdown. No new credit cards, no financing, anything, nothing until the keys are in your hand. Real quick, if you're watching this and thinking, okay, I need someone to actually walk me through my situation, that's exactly what I do. I work with buyers in the GTA and KWC. There's a link in the description to book a free call with me. WhatsApp is there too, because I know that's how most of us actually move. Alright, coming back, bank versus broker, this one matters. Most of us do the same thing. We walk into whatever bank we already have our checking account with. They give us a number. We assume that's just how it is. That number is not the deal, it's their deal. A mortgage broker doesn't work for one bank. They work for you. They take your file and shop it across 30, 40, sometimes even 50 different lenders, banks, credit unions, alternative lenders. And they find the one that fits your situation, not the average Canadian buyer's situation, your situation. Okay, real example. Same client, same documents, same week. Their bank offered 4.29%. Broker came back at 4.04%. That's a quarter point on a $700,000 mortgage over 5 years. That's thousands of dollars for making one extra phone call. And on standard A-lender deals, which is most buyers, the broker charges you nothing. The lender pays them. So you're getting the whole market for free. One honest note, if your file ends up needing a B lender, which can happen if your situation is more complex, brokers typically charge around 1%, worth knowing upfront. But for most buyers, especially straightforward PR holders with steady income, you pay nothing. At minimum, get a second opinion. Your bank will still be there, but so will a much better rate. Okay, this is literally the answer to the title of this video. What do you actually do before you talk to a realtor? You get your documents together, because walking into a pre-approval meeting unprepared is like showing up to a visa interview without your paperwork. You already know how that ends. The full checklist is downloadable in the description. Save it, send it to yourself, send it to whoever in your circle is house hunting right now. Short version so you know what you're walking into. Identity, passport, PR card, SIN number, income, last 2 years of T4s, last 2 NOAs from CRA, recent pay stubs, and an employment letter from your employer. Down payment, 90 days of bank statements showing where the money has been sitting, not just the current balance, the history. And the one that trips up our community specifically, if your parents or family are gifting you part of the down payment, which happens a lot, we know how we operate, you need a formal gift letter, not a WhatsApp screenshot, an actual letter your broker will template for you. It says clearly this is a gift, not a loan. Because if the lender treats it as a loan, it changes your entire debt calculation and can kill your approval 2 days before closing. I've seen it happen. Don't let it be yours. Alright, 5 things before you go. Pre-approval, pre-qualification, know the difference. Stress test, your real budget is lower than the bank sounds. Find that number first. The 3 traps, build credit early even if programs let you skip it. Wait until your Canadian income is on paper, and after approval, don't touch anything. Don't buy anything until the keys are in your hands. Use a broker. It costs you nothing on standard deals and almost always beats the bank. Get your documents ready now, not when you're ready to buy. That checklist is in the description. Do those 5 things and walk into your first realtor meeting with the letter in hand. The documents ready and nothing to scramble for. That's the move. If this helped, share it. You know exactly who in your family group chat needs to see this. Don't forget to subscribe so you catch next week's video. I'm breaking down the FHSA, the first home savings account. You contribute up to $8,000 a year, $40,000 over your lifetime. You get a tax deduction on the way in, and when you use it for your first home, the withdrawal comes out completely tax-free. That's double tax benefit the government handed first-time buyers, and most people in our community have never even heard of it. There's also the home buyer's plan, up to $60,000 out of your RRSP for your first home, tax-free. I'll be covering both next week. Thank you so much for watching, and I'll see you in the next one.